I don't think the Fed has anything to do with what we call inflation. It's oil prices and used car prices that were triggered by the base effects of shutting an economy down, then turning it back on. And look, CPI perfectly correlated 16 months after M2 growth. M2 growth went negative for the first time in, I think, 96 years. Let that one sink in. It's been 96 years of constant money printing since the Fed was created to diminish the value of the currency, to steal wealth from the masses and give it to the people at the top, which, right, income and wealth inequality is where it is. So mission accomplished by the Fed.
Hey guys, welcome back to Library of Wealth. Today we have Morgan Creek Capital's Mark Yusko, who recently shared his thoughts on the current economic situation, and even he is surprised by what's going on. He challenges the notion that inflation is caused mainly by the Federal Reserve, and instead attributes it to factors like oil and car prices. Mark believes that the Federal Reserve has been printing money for 96 years to deliberately diminish the value of the currency and contribute to wealth inequality. Mark sees the current state of the economy as a cause for concern. Despite reports of low unemployment rates, Mark believes that the data is being manipulated and that the true economic activity is abysmal, with levels not seen since the global financial crisis. Yusko also draws comparisons between the current economy and the period from 1968 to 1982, where there was little economic growth and the stock market remained flat for 14 years. Mark predicts we'll see a similar outcome in the United States. Let's get right into the latest interview with Mark Yusko. Before we dive in, don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
The challenge now is, again, I don't know, all of this is literally nonsense, in that there is no pricing power for employees. How many announcements of 10,000 workers being laid off have you heard in the past month? Every single day, another company is laying people off. Our company, for the first time in 20 years, we had to let some people go. It's just never, we never got to that point before. This has been, and this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers. Again, the massive engineering, right, by taking people out of the labor force, making the labor force seem smaller, so the percentage of unemployed, those people are still working. But just because they turn 65 doesn't make them out of the work. That's the way they do it. And the birth-death ratio nonsense. So I hear the narrative that people have crafted, and I hear the torturing of the data, right? If you torture the data long enough, it will confess. The torturing of the data continues, but you go around and you look at economic activity, which is the true measure of whether wages are good or not good, or economic activity, it's not so good. In fact, some of it is downright abysmal, like plumbing levels we haven't seen since global financial crisis or the Great Recession or the period, the tech wreck. Look, from 1968 to 1982, the economy went precisely nowhere. We had multiple recessions, multiple recoveries, and quote unquote these soft landings. Because I guess if you fall from a really low level, it's softer than if you fall from a really high level. So the fact is you never took off, you didn't crash. So I guess that's one way to look at it. But from 68 to 82, stock market was precisely 1,000 points. The Dow Jones Industrial Average was 1,000 points for 14 years. And yes, it went up and went down, and there were big drawdowns and big recoveries. And there's another bull market. Dead flat for 14 years. So yeah, great. That's where I think we probably are. I think we're going to have a lost couple decades of basically no economic growth, kind of like Japan's had for the last 3 decades. Stock market probably does this, right? I made the bet with Kevin O'Leary on on CNBC 4 years ago that Amazon would be dead money for a decade. And so far I'm winning. And I don't, again, I'm not gloating in the fact, it's not that Amazon's not a good company. It's a great company. But they just reported the largest loss in their history. Apple was bad. Amazon was bad. Shoot, I can't remember the other two. But all four of them, bad. And on top of that, that's on top of Microsoft was bad. Netflix was bad. Even Meta was bad, right? They missed on revenue. The revenue growth is turning down. Apple's, which just went negative. So those are not growth companies. Look, there's no question Q4, fourth quarter, massive government spending, big inventory build. And Powell did say, right, don't expect those two things to continue, right? So he was kind of warning that Q1 GDP is going to be not so great. But if you look at Q4, 75% of the growth, it wasn't really growth, was this draining of the TGA, government spending, and building up inventories. Now look, we did talk about this a few weeks ago, saying that the amount of tax loss selling that occurred in 2022 did set the stage for the potential for this January effect. Now I didn't think it was going to be this crazy, where you had stocks going up 30% every day. And companies like Bed Bath and Beyond, I mean, bankrupt, like liquidating, gonna go away, and people are still punting in that stock. So good for them. Musical chairs, it's not a game I like to play, but here's the thing that I just don't understand is the Fed is not adding liquidity. They're just not, right? They're simply not. The ECB, not. See, the ECB is now in the hot seat. Ms. Christina, she's got a problem. She is now the one that has to raise. She's 200 basis points behind everybody else. And that's going to be a tough one for Europe. Now, the European banks love it, and the European banks are going, bananas. But rest of Europe isn't going to like that very much, particularly the exporters, because it's going to strengthen the euro, and dollars continue to fall. Euro is going to strengthen. The yen is the wild card. I mean, Krotosan unleashing this Kroto tsunami. That should actually weaken the yen pretty badly, which maybe the dollar stays flattish. But the euro probably going to rise a lot, and it's going to be tough to sell, Volkswagens and Audis if your currency's strengthening. So I think Europe's going to struggle from an economic growth perspective. In fact, I think Germany just went negative in Q4, like 0.2 or something like that. So economically, I get why Jay Powell is saying, don't count on the government spending to continue, because we're almost out of money. And they're certainly not going to increase taxes, because that's not a popular platform to run on. But I still come back to PMIs are rolling over, industrial production is rolling over, new orders component of PMIs are rolling over. I don't see any catalyst for a strong recovery. And if the definition of soft landing is the Chuck Yeager, right? Any crash you can walk away from is a good landing. Okay, well, we're not going to crash, but I don't see us getting back in the sky anytime soon.
Mark notes that the increase in government spending and inventory buildup in Q4 of 2022 contributed to economic growth, but that it's not expected to continue as the Federal Reserve is not adding liquidity. He also highlights the challenges faced by the European Central Bank in raising interest rates, which will likely strengthen the euro and make it difficult for exporters. Mark believes there isn't a strong catalyst for a recovery, and the current situation is a soft landing without a crash. However, there is no sign of a return to growth in the near future. Despite the bleak outlook, Mark remains optimistic about the future of decentralized, non-government controlled currencies such as Bitcoin and other crypto. What do you think about Mark Yusko's outlook for the current economy and where we're headed next? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.